Our lunchtime speaker today is Sam Stovali, and he is, beyond being the chief equity strategist for Standard & Poor's, he is, for us, a wise guy. A good wise guy. And I say that because Sam has been working with WISE for nearly 15 years. He speaks at our conferences, he visits the classroom, he does teacher training workshops. He really likes young people, and he's very interested in financial education and the financial literacy of young people in this country. And so he's a friend of financial education. And I asked him to please join us today, and he said yes, without even a second thought. In fact, just so that you know, it's his first day back from vacation. So, help me to welcome Sam Stovali. I should also mention that his topic is wonderful. And I'll ask him, he'll tell you what his topic is, but it's a good topic.
Let's see, could it be Outlook 2003? Thank you, Phyllis. I always enjoy working with Phyllis. At one of the events we did a little while ago, I said that the first time that I did something with WISE, it was a very simple reason, and the answer is because she had asked. And it's almost like you could see the balloon deflate, and she goes, "Really? That was it? Just because I asked?" And I said, well, that was because that was the reason why I said yes the first time. I said, but because it's you, I've been continuing to say yes. So I'm very happy to be here. Also, I think there's a little bit of history in my life that makes the connection. I was certified to be a social studies teacher back when the Dead Sea was still alive. I had vowed I was going to accomplish 3 things in my life. I was going to teach social studies, I was going to coach football, and I was going to develop a potbelly. And I can honestly say I've accomplished at least one of those things. So, in a sense, I can actually say I've done 2, mainly because I still believe that I teach. Everything that I do, from the research that I perform, the articles that I write, the presentations that I give, you'll notice that a lot of what I'm doing is teaching. I'm not just telling you what our strategy is, I'm not telling you to buy anything, etc. I'm really asking questions that I might not know the answers to. I perform the analysis, and then I say, hey, I want to share the results. So I'll probably never get rich on Wall Street because I'm too willing to give away all of the secret sauces. I wrote a book called The 7 Rules of Wall Street, which are rules of thumb or old sayings that you can use to build portfolios of sector ETFs that have beaten the market. So check it out, 7 Rules of Wall Street. It's now discounted on Amazon. But the other 2 books that I wrote are now selling for more than $100 a copy on Amazon, so get it early. I'm going to talk to you about the topic, is it time to buy or bail? Because a lot of people have been saying, Sam, I just remember what happened in 2008, and as a result, I'm very worried that this could happen all over again. And I can understand, because I can be my portfolio's worst enemy. I am convinced that the person who gave me the best bit of investment advice was Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." So I was thinking, well, what are my limitations? And my ego only allows me to admit to 3. I am indecisive. Indecisive because I have so much information at my fingertips that it's like, well, could the market go up? Yes, here are the reasons why. Well, could it go down? Yeah, here are the reasons why. So it's like you're, in a sense, paralysis by analysis. I am so indecisive that I have now concluded my favorite color is plaid. I'm also impatient. If I buy a stock, I want it to go up right away. If I sell it, I want it to go down right away. But what do you expect from a guy who gets upset if he misses a slot in a revolving door? And then lastly, I'm emotional. We know that there are two emotions that drive investors, fear and greed. I actually think it's just one. I think it's fear. Fear of losing money on the way down and fear of missing out on the way back up. So unfortunately, in this day and age of instant information, I can experience both fear and greed at the exact same moment. So my thought is, okay, now that I've sort of divulged these inner secrets to you, what do I do about it? Well, I try to extract myself from the investment equation. I try to not have my emotions undo all that my portfolio is trying to do for me. In a sense, you don't want to buy high and sell low. You basically want to buy low and sell high, or just keep buying. But then the question is, how do I know when to buy? And I'm going to talk to you about that. I also, because I was a history major, and because I'm using history as a guide, it's a very good guide. It's not gospel, but it's a good guide. Sometimes it can help establish the framework of where we are in the economic cycle, where are we in the stock market cycle, what is likely to happen next, and I put a lot of probabilities on there. If a pot of gold lands there 86% of the time, are you going to stand here? So, no, you're going to be standing right over there. I don't want to be somebody who says, yes, it only works 1 out of 15 times, but when it does work, it's really good. No, I'm like Pavlov's dog. I want to be fed frequently enough. I want to be reminded that whatever works will continue to work more times than not. So the question that people was asking me recently, they whisper, they go, Sam, because the Fed is thinking about tapering, pulling back on its bond buying program, won't we end up like 1994? So they whisper 1994 as if it's a year that's going to conjure up bad images. So I said, well, let me look back to 1994. Let me find out what actually did happen. Well, we do know that the Fed raised interest rates 6 times in 1994, and it raised a 7th time in early 95 for good measure. So what do you think happened to the market? Did it tank? Anybody think it tanked? I can hear a couple of you nod your head, but I want to see some hands. All right. Anybody think, nah, we just took it in stride? And then lastly, who does not like to raise their hand? Okay. Well, what I basically found was the market actually did relatively well. For all of 1994, the Europe, Australia, and Far East international indexes, the MSCI EFA was up more than 8% if you include dividends. Commodities were up 5+%. Real estate investment trusts were up more than 3%, and the S&P was up 1%. So in a year in which the Fed doubled interest rates from 3% to 6%, the market still held up. Bonds did not do very well. Barclays aggregate was down 3.5%. The long Treasury index, so 20-year Treasury bonds were down more than 7%. So those markets got hit pretty hard. What I did was, this is a map of how the market performed on a day-to-day basis. Each of these vertical lines are when the Fed raised rates. And you can see that the market was taken a bit by surprise, and that we experienced a near 9% decline from peak to trough that year. Now, a 9% decline is not that big of a deal. Anybody want to guess how many times we have had a decline of 5 to 10% since World War II? About my age, 56. Actually, I'm actually 58. I know I don't look a day over 57, but we've had 56 times since World War II that the market has fallen by 5 to 10%. So in other words, it happens almost every year, meaning every year in which we're in a bull market environment, we go through a decline of 5 to 10%. Add in the 19 nervous breakdowns that we've also had during that time frame, and we have well more than one per year on average of declines of anywhere from 5 to 20%. So it's no real big deal. But the market pretty much got its arms around it, said this economy is not going to fall into recession, and so it started to work its way higher. I'm not going to go into much detail here, Phyllis did not mention that I am also a numbers nerd, but at least I'm an extroverted nerd, which means I'll look at your shoes when I'm talking to you. And I would love to go into a lot of detail on this, but I won't. But it basically just shows what happened in the deepest decline period, and then what happened by the end of the year. So for a lot of the sectors in the S&P, for the S&P itself, and many of the underlying sub-industries, what was negative for about 5 months became positive. So if you just wait long enough, the market does tend to recover. We think that the market probably will continue to do relatively well this year. This is our global economic expectations. The whole world is likely to see about 2.7% growth in the third quarter, 3% in the fourth quarter. We're going to be seeing most of the gains occurring in the developed nations, mainly because we think that slowly Europe is going to be coming out of its recession. The frontier markets, the very small countries that are just developing, are likely to see about 3.3% in both quarters, and emerging markets about 5.3%. So good economic growth in these smaller countries and an improvement here in the US. The driving force behind why investors invest and why stock prices are valued the way they are earnings. And we think that earnings are going to continue to rise. About 7% this year, and then as much as 11% in 2014. Are stocks expensive or cheap? Who thinks expensive? Okay, who thinks cheap? Well, let's go to the videotape. Here we are right now. The trailing 12-month price-to-earnings ratio is about 15.5 on the S&P 500. There are two kinds of earnings, operating and what's called GAAP. Operating are called earnings before bad stuff. GAAP is like Prego spaghetti sauce. Everything is in there. So this does not include a business you decided to sell because it wasn't doing all that well, because you're only looking forward in what is continuing operations, whereas generally accepted accounting principles has everything in there. So 15.5 times, the median PE over the last quarter century has been almost 18, so we are at a 14% discount right now to the median over the past 25 years. So some would say, actually, we are now cheap, or at least we're not as cheap as we were in March of 2009, but we are fairly attractively valued when compared with longer-term history. And if you look to the end of this year, the end of next year, valuations look very attractive. If you include everything, we're trading at a 10% discount over the past 25 years. And again, earnings growth and valuations look relatively attractive over the next year or so. So I don't think that earnings are likely to be the big problem. I think that investors are no better than hyperactive first graders playing musical chairs, always trying to out-anticipate the other. What are they trying to anticipate now? The Fed, exactly. Higher interest rates. Well, what typically happens to the market when rates rise? Well, what's interesting is that since 1953, which is as far back as the Fed gives data for free on their website, if you go on to www.frb.org, there's an awful lot of data at the Federal Reserve Board, frb.org. Interest rates, mortgage rates, things like that. A lot of free data that's out there. What I did was I computed, I said, okay, for each month in which interest rates rose, what happened to stock prices? I found that on average, that in all occurrences up until the line in the sand at 6%, stocks rose when interest rates rose. I think it's because investors are saying, well, I know what's going to happen with my bonds. It's the seesaw effect. As yields go up, my prices will go down. So let me sell my bonds. Where am I going to put my money? I don't really like to put it in cash or leave it in cash because it's not working for me. So let me put it into stocks because I'll take the bad with the good. The bad being higher rates, but the good being an improving economy which is pushing rates higher. An improving economy does what for corporate earnings? What does it then do for investor optimism? And then what does increased investor optimism do to what's called the PE multiple? Meaning, how much are investors willing to pay for stocks? Instead of 15.5, the average since 2000 was 16. The average since 1988 was close to 18. So we could see what's called PE expansion or multiple expansion. People are more willing to pay a higher price for stocks, which will help push up the value of stocks. Is this going to be a smooth ride, or do you think it's going to be a volatile ride? I flew back from Miami yesterday. I would say about 7 times the pilot came over the loudspeaker and said, "Please fasten your safety belt, we're approaching turbulence." Well, I think we are approaching turbulence as well. In 2012, we only had 3 days in which the S&P declined by 2% or more in a single day. We've only had it happen twice this year. The average since 2000 was 15. We had 21 such days in 2011 and 50 some odd days in 2008. So right now, we're actually going through a relatively calm spell in the market. So if we simply get back to normal, we would probably end up with something closer to 15. You had a question, sir?
Yeah, could this be also the result of as a result of computerized trading, which has increased since 2000?
Could we be seeing more volatility because of computerized trading? Sure, I think that's a possibility. You know, we have black pools, we have these the high frequency trading, we have these inverse ETFs, etc. So there's a lot of mechanisms out there that could add to the volatility. But the reason why I'm bringing this up is not because I want to give you an additional reason to sell. Yes, ma'am?
I just want to ask a question when you're done with this.
Okay. I don't want to give you another reason to sell. I just want you to be aware of what is likely to occur. Let me take that story about the pilot one step further. Have you ever heard a pilot, instead of saying, "Please fasten your safety belts," saying, "Don your parachutes and assemble by the door"? So I think that's the same with the market. If you are aware that volatility is around the corner, you are much more likely to weather that volatility and not allow it to cause you to do something bad with your portfolio.
At the slide before, you said up until 6%, the market continues to rise. Could you just address what happens at 6%?
The question was, why is the line in the sand at 6%? I think it's because beyond 6%, investors then start to say, you know what? Instead of just taking the foot off the gas, which the Fed is doing now or will be doing by easing up on the bond purchasing or engaging in the tapering program, they might end up tapping the brakes as they did in 1994. But if they start slamming on the brakes, then maybe we go into an uncontrollable skid. And that's what I think investors worry about, is that beyond the 6% line in the sand, maybe the Fed is going too far, is raising rates too quickly and too much, that could then end up throwing us into recession. Because usually what we find is that they're raising short-term rates more dramatically than long-term rates, and sometimes we end up with what's called an inverted yield curve, meaning that short rates are higher than longer rates, and then that usually is a sign of recession, a pending recession, and a pending bear market. Yes, sir?
When the 10-year T-note rises significantly enough, doesn't it suck money out of stocks and things? Because why would you not buy a T-note at 7% when it's a fixed, safe investment?
That's another good point. What this gentleman is reminding me is that it also increases the substitution attractiveness. That when the yield on the 10-year note goes above 6%, it's like, wait a minute, if the long-term average return for stocks is like 6.5 to 9.5, depending on which guy you listen to over what period, if I can get that with almost no risk, then maybe I am better off buying the 10-year note at 6+%, because it does look relatively attractive. The only question is people don't know how high the 10-year note will go, because we know that it did approach 20% back in the early 80s, but, but still, there is that substitution. Yes?
When does the fear of inflation set in and the market sort of stalls because of this fear that prices are getting too inflated, or
Inflation of commodities or of assets or what?
either one?
Well, the gentleman said that inflation is also an indicator. You could look at it both ways. I do have a slide that shows, going back to 1948, if you put the inflation rate into quintiles and say, where are we right now? I'm not going to leave the wrong finger up. We're actually in the second, maybe it should be this one, the second lowest quintile of inflation right now. And what history says, but does not guarantee, is that instead of us trading at below PE of 18, we should be trading at a PE of 20. So we should be, again, anywhere we're at a 10 to 15% discount currently, not just based on all observations going back, but looking at those observations during this kind of inflationary environment. And historically, the market has risen 9% in the coming 12-month period whenever we have been in this kind of a low inflationary environment. So basically what is happening is there are so many things that investors can look at to help to decide whether the market is likely to go up or down. And then they always ask themselves, this time could be different. They say, Sam, why do you even bother looking at history when today everything is so much different than it was X number of years ago? And I keep thinking, gee, it sounds like Yogi Berra. Didn't he say that history ain't what it used to be? And my feeling is there's one thing that remains constant whenever we're dealing with stock market history, and that is human involvement. So it's almost impossible for people to remove their emotions from the overall equation, because even program trading is based on trying to remove risk. And if we see an acceleration of downward movements in the market, investors tend to say, I don't want to catch a falling knife, I'll sell now, and I'll look to buy later on.
Is the controversy of the reading with quantitative easing 1 and 2 with the Fed, isn't the controversy that we're printing way too much money and that the stock prices seem to be rising, but because it's rising is because we're literally printing more money and trying to ease the markets by pumping more funds and liquidity into the marketplace, where it's inflating all of these prices and it make it seem like we're out of a recession, but we keep printing more money, through the Federal Reserve. So, what's your opinion on that? Is that a controversy, or is that really?
The question is, what role does the Fed play in the economic recovery, in the stock market recovery, and would we have seen that without the Fed's quantitative easing 1, 2, and infinity? I think that the Fed has been integral to this economy and stock market's recovery, because if you remember, Ben Bernanke got his PhD by studying the Great Depression. And he knows that back in 1937, the Fed started to raise rates because they thought the economy was improving. The Treasury started to increase the reserve requirements of banks. All that did was throw us into another very deep recession and throw us into another mega meltdown bear market from which we did not bottom until Doolittle's raid in April of 1942. So the Fed doesn't want us to make the same mistakes as they did back in the 1930s, and even closer to home in terms of time, they don't want to do what happened in Japan in the 1990s and the 2000s. They want to make sure that they do throw an awful lot of money, or at least make it available to people out there. The first question I get from people is, well, Sam, isn't that going to instantly lead to hyperinflation because you have so much out there? And my feeling is, well, let me pose it a different way. If Hostess doubled the output of Twinkies, but nobody ate them, would we still gain weight? So just because the Fed is flooding the economy with money, if we're not seeing lending increase, we're not seeing the velocity, the turnover of money picking up, where's the inflation going to come from? So in many ways you can say a lot of this has to do with confidence. How do we increase the confidence, the availability of funds so that people know? And in many ways we could be saying, let's put the money back into the stock market, because then in a sense it's a vote of confidence on the economy. You know, let's make everybody sound like Richard Gere from Officer and Gentleman, who said, I got nowhere else to go. You know, so if interest rates are as low as they are, where else are they going to put their money? So I think that what the Fed did was, you know, very much planned, and they are keeping a very close eye on what may happen next. They don't have the answers to everything, but yeah, I think QE was definitely part of the overall equation.
Oh, I was going to say, I do agree. I think they've done a great job in some ways, but you can measure inflation by not necessarily looking at a particular number, but by people's purchasing power. And the truth of the matter is, you know, maybe inflation, the number isn't showing, but people's purchasing powers have, you know, like decreased substantially, even though maybe inflation numbers aren't showing. And in that respect, it's almost like the same thing. You know, people cannot do what they used to do before. People's purchasing powers have decreased, and that is a function of the fact that there has been so much liquidity flooding the market, and flooding the economy.
I think we could also blame unemployment. We could blame the people who are getting jobs. Are they as good as the jobs that they lost, etc. While I think that the government tries to satisfy the statistical questions with headline unemployment, which is the top line, but also the U6, which includes not only the unemployed, but also the underemployed, the disgruntled, those that have left the workforce, etc. Even that number is coming down. But I think people are basically saying, yeah, but I'm feeling something that's different than what the federal government is telling me based on these impersonal statistics. So, you know, I guess in some ways you could say that everybody is right. What you do is you look to retail sales and you say, yeah, but are people spending more? And if they are spending more, can that justify the corporate earnings that are being forecast, things like that. So, you know, I'm not saying you're wrong, I'm agreeing with you, but it all depends on what you look at and why you look at it. You know, is it going to help you to decide whether these earnings are for real going forward? Let me show you one other slide, and that is, this is the one where I said I like to use history to help me to know when to buy. I'm one of those semi-perennial optimists, meaning my philosophy is when life gives you lemons, make whiskey sours. So what I did was I said, you know what? I find that a lot of people are very good at knowing when to get out of the stock market, but they're not very good at knowing when to get back in. And so as a result, they end up getting back in at a price that's higher than when they got out. So maybe we can try to change that. Maybe people don't get out at all, but if they have money on the sidelines, they know when to start putting some of that money to work. How do they get money on the sideline? Well, either by earning it or from dividends that are not reinvested. We have had 56 pullbacks since World War II. Average decline 7%. It's taken us only 2 months to get back to break even. Only 2 months. We've had 19 nervous breakdowns. Who sang that song? Right, Stones. We've had 19 nervous breakdowns, average decline of 14%. It's taken us only 4 months to get back to break even. When we got back to break even in February of 2012 after falling more than 19% in 2011, people said, oh, we went too far too fast. And my response was, no we didn't. It actually took us a month longer than it normally does. The average bear market declines 28%, but for what's called the garden variety bear markets, it takes us only about a year to get back to break even. Did you raise your hand?
Mister, please. No, what does garden variety mean?
Garden variety bear market means that we fell by 20 to 40%, whereas what we experienced in '08 was what I call a mega meltdown. So '08, 1973, and then you have to go back before World War II to find other mega meltdowns. So if Sir Arthur Conan Doyle, who wrote Sherlock Holmes, was an investor, his book, The 7% Solution, could have been a good guide for how investors put their money to work. Because if each one of the average declines is divisible by 7%, 14%, 28%, maybe it wouldn't hurt if you say, you know, oh, this market's going down, boy, it could really get bad. You put your money to work at 7%, 14%, 21%, 28%, and more times than not, you will be, doing your portfolio a favor. It took us only 3 years to get back to break even if you include dividends. It took us 4 years if you only look at price in the S&P 500. No guarantee it's always going to be this way, but I find that if you are investing for the long term, you're better off buying than you are bailing. Yes, ma'am?
So someone mentioned computerized trading, and this kind of is telling me to buy. But Warren Buffett has said to me, if I don't have $1 million, I should just stick in index funds, because I can't play in this market anymore. Okay? I can't pick stocks, I can't do computerized trading, so just stick with the S&P 500 or whatever it is.
Sure.
And stay that way.
Well, and I'm not saying that you should do anything different. I mean, if you're in the index fund, what I'm saying is buy more of your index fund. If your question is, Sam, I have all of my money in the S&P 500 index fund or wherever, the XYZ index fund, the market has fallen by 5%. What should I do? Should I sell? It's like, no. Be prepared to add money to your current index holdings.
Right, but my point is, unless we're talking about what we're investing in or the TDA, most of us are minor players and we should be in real kind of conservative practice matching the markets.
I'm not disagreeing with you. The question here is not what kind of investments you should have, but should you buy more or should you bail out of what you have? So whether you are dealing with individual stocks, whether you are dealing with futures, but I would say no, most of the audiences that I talk to probably have index funds like I do. My compliance department says, can you make money on it? Yes, then you can't own it. So I have to go basically with indexes, and actually in the long run you do better with indexes anyway. So all this says is if you're thinking about selling, my response is no, you're better off either rebalancing or add to your equity holdings whenever the market as a whole has dropped by multiples of 7.
Could you explain with Facebook when everybody wanted to be that quick get rich quick thing? What was the problem? What was the blunder that people did when they jumped at Facebook at that time? Could you explain?
The question was, Facebook came out at what, $42 a share, I think it was? 38. And then it promptly dropped into the mid-teens, mid to high teens. So what went wrong? I think basically what went wrong was that people really didn't know how to value. How do you price Facebook? How do you price something like that? So they really weren't sure what multiple to give it, etc. So they ended up saying, well, I really should have been looking at clues as to, delaying when they actually went public, increasing the number of shares available. It gave some of the managers time to sell some of their earlier shares, etc. So from a behavioral standpoint, in retrospect, you said, oh, I should have spotted this, when I think it's almost like, the Americans just before Pearl Harbor, you could claim 50 years later we had all these clues, when at the time, maybe we didn't. In the back.
There were very specific things that went wrong with Facebook. One of the things is that their advertising earnings were declining. They weren't increasing at the same rate. There were several things that went wrong. So I actually taught my kids all about Facebook versus Google, and why was Facebook so successful and why was Google not successful in the
Well, that could probably end up being a good case study.
Yes, I agree with that.
Why Google over Facebook?
Yeah.
Yeah, my understanding it was overvalued in price initially, but there was electronic, this they told us at the New York Stock Exchange, that electronic trading there was a lot of overload with electronic, everybody trying to order at the same time. And when it started to fall, the algorithms actually made it fall a lot faster. So there was a big correction that needed to be done to electronic trading.
Okay, yes.
Wasn't it also the tremendous demand? Because I know people who bought Facebook, who knew nothing about the market but were on Facebook, and the optimism about it. They thought it was going to be another Apple or Google without realizing social media had limitations. And Morgan Stanley or Goldman Sachs, who were involved, kind of broke that optimism into the price, and it never realized.
So do you think it was fear or greed?
Greed.
I mean, it's a stupid question, obviously, but, I mean, people, it was just so much greed and people didn't really look at the signs.
Right.
Okay, so we're good?
Yeah, just summarize very quickly by saying that historically, 2013 could end up being a very good year. We are in the 5th year of a bull market. 83% of those bull markets that celebrated their 4th birthday went on to celebrate their 5th birthday. Average price increase, 21%. The market was up in January and February of this year. That's happened 26 times since World War II, and in all 26 times, the market posted a positive 12-month total return, with the average being 24%. Rising stocks traditionally pressure bonds, but don't tend to, over the longer term, pressure equities. Yes, we might end up having an initial shakeout. We had a 5.6% decline this time. Maybe we end up more when the Fed does actually taper or start to raise interest rates, but usually once we go beyond the 6% line in the sand is when investors start to get nervous. We don't see a recession on the horizon. Yes, it's a low-flying recovery, it's gaining altitude, so we think it's less and less vulnerable to dangerous downdrafts. Earnings are likely to continue to improve, not at double-digit paces, but at an improvement based on underlying revenues, share repurchases, and continued cost-cutting. And our chief technician, whom I call Chartman, he says that a series of all-time highs are now likely for the rest of this year. So with that, Anand, I'll turn it back to you after everybody claps.
So I don't know if we mentioned this, but we ordered 60 copies of your book, and we cleared out Amazon.
Wow.
So we're waiting for, we have a third of those books, and we're waiting for the other 2/3. So,
Well, thank you.
yeah, of course.
Thanks, everybody. And if you come to an event and you know I'm there, bring your book, I'll autograph it.